All right, good morning. Before we get started on today's $1 million coffee hour, let me ask you guys something. You can drop it and share in the chat. What happens when rules of the mortgage world suddenly change? And we kind of seeing it real time here. We're going to talk about the 50-year mortgage. But do average families really win at the end of the day? Or does the system get pushed a little bit too far? And so we're going to dive into that today and really go into the biggest shifts that we're seeing in the housing finance market right now and what that means for everyone that's trying to build wealth. Because right now, we wouldn't be tuned in today if we weren't trying to build wealth. So with that, we'll kind of get started. And for those live in the studio, then we'll go through and do what we do and really dive into the details and do a little bit of networking and see the deals that are moving, the challenges that we are facing as investors, and kind of have a little mastermind event. So drop in the chat if you guys want the link to come into this live studio behind the scenes where we're doing a little bit of networking after today's presentation. So we're going to dive in today and really go into everything that's going on right now in the real estate side of things. Really, the outside of the Jeffrey Epstein files, I think the next big topic right now that's happening in the United States is the mortgage market, and where we are with the proposal with the 50-year mortgage. Fannie Mae no longer having a 620 credit score minimum, and what does that mean? So we're going to dive into those things today and really focus in on um, these that major shifts at the end of the day. If they get implemented, they're going to be major shifts. And whenever the rules change, we get both opportunity and risk. And so let's walk through that today and see what this means for homeowners and us as investors. All right. So one of the things we're seeing two major shifts happening right now at the same time. First, we have the credit requirements that are getting easier. People couldn't qualify before, now making that maybe now they can get a loan. And so I think that's one of the things that we're seeing right now with unaffordability being at an all-time high. I think it's upwards of over $40,000 right now is the difference in regards of where household income needs to be and where it is right now on average for a homeowner or family to afford a home. And we know that is insane. And so for right now, it makes more sense for a lot of people to rent versus own. And on the backdrop of that, we also know that there are a lot of jobs that are tied to the real estate industry. With every transaction, there are a lot of jobs tied to those. So when we see transactions at historical lows and aren't a lot of people buying homes, so guess what? That's affecting appraisers, contractors, real estate agents, title companies, uh, inspectors, the homeowners, and looking for housing, and everyone else in between that are part of the transaction. Your mortgage broker, the finance company, the banks, and everyone. So those are the things that you have to realize that there is a broad impact when housing slows down. And so right now, with we haven't seen interest rates this high in a while. That it's between interest rates and the lack of affordability, just with where gross the income is for households, people aren't able to afford a home. And so right now, the administration is trying to figure out ways to break through this stalemate and really have more transactions happening and get more people into loans. And so this could be good, but I think it could also be bad. And so the thing is, when you really look at the heart of the 50-year mortgage, it makes payments smaller, but it keeps people in debt much longer. These changes, they open the door for more buyers, but we got to ask ourselves, how is the market going to stretch before problems start showing up? And I think that's where, at the end of the day, the core question comes down to it, that you're going to expand access, but now are we taking on more risk? Are we actually bringing more instability in the market versus stability? And the thing is, there's no question that more people will be able to buy homes, but lower credit scores and longer loan periods also mean people won't build equity as fast. And something, and the thing is that if something goes wrong, we already know if you have to replace an HVAC, you have anything, something happens in the house, you replace your refrigerator, or a water leak or something causes damage to a cabinet. Anything that happens with real estate, that when you look at long-term ownership and you have to replace something and it's expensive, that you don't have a safety net, you don't have the equity, you don't have the ability to sell in a short amount of time if you need to, Or, and when we start talking about investors and what we're looking at doing, we try to teach people how to build wealth. The thing is, you're being locked into a 50-year long term that could hurt you long term, hurt you later down the road. And so that's one of the things I think we have to really look at and do the math on. Is this beneficial in the long term? Should you save a little bit longer where you can afford a 30-year mortgage versus being able to being stuck in a 50-year loan product where you're not building equity that fast? And so that's the core question that, or what are we doing and where the market is going? And so that's the thing when you look at the market and the behavior of families and how everything is changing, that the view of home ownership has shifted because of the lack of affordability. And the thing is that after you look at it, it's like, okay, we're reducing the payment a little bit, not a lot. And I'm gonna get into a case study here soon to show you we're reducing the payment, but at the end of the day, is this the best thing for you and your family when you start looking at a 50-year mortgage, the lack of equity creation over the short time frame where we already know that most people don't stay in homes that long? Are we signing ourselves up for more long-term risk, and especially now putting our credit at at a disadvantage because now if something happens, a job change, or we're laid off, or we have to move, relocate for family, or any of those situations, if we're locked in a 50-year mortgage and we only been in it for 5 years, 6 years, we've had built up no equity. We can't even pay the expenses to the real estate agent to sell the property. And if you have to make any repairs or renovations, you're gonna be upside down. And if you didn't put any money, if you didn't put any money down, like for a VA loan, or if even if you did conventional and put only 5% down, you could be in a bad shape. And so I think one of the things that you really want to look at for real estate investor side outside of just the home ownership, now you're looking at the attractive yield. Yep, you're going to be a little, your cash flow is going to be a little bit higher, but are you taking on more risk? If something catastrophic happens, or something that didn't come up in the home inspection, or is the risk worth the reward when you start looking at the cash flow and the potential upside and the lack of equity that you're able to build up in the property? Does it make sense? And I think when you really look at it and study it, and historically Americans move anywhere from 6 to 10 years. A lot of people put out 7 as the number, but anywhere from 6 to 10 years that most people move and they get out of their house. Especially for us military, you're in the home 3-4 years maybe, and you're moving out. And so really now when you start talking about a VA loan and a 50-year mortgage, and you already are highly leveraged with a 30-year product, but now the 50-year, that if you move out in 4 years and then you put a tenant in there and they tear your place up and you got to drop 5,000 to paint a 2,400 square foot house, you have to replace the floors at the same time. They jacked up your carpet, and like you could be out of a lot of money, and then you want to look and turn around and sell, and and you're probably upside down depending on what the situation has been going on. And so that's where you really want to look at the cost benefit of doing a 50-year mortgage and your moving patterns. Are you going to be here? Is this a forever home? Because 50 years is pretty much forever. When you talk about your adult life, if you buy it when you're 18, that's 68. And we know most people don't pay off the loan, but even over the last 4 years, there was a huge run up in equity just with the increased inflation that happened after COVID. And we see that, the home prices go up. But the thing is, if you don't have a low interest rate and you have a 50-year mortgage, you're going to save a little bit on the premium, but on the monthly payment. But in the long term, you're not building up equity as fast. Not even, I think, at the deficit of 3 or 4x when you start comparing the numbers. And so that's one of the things we're really looking at, where we are from a risk perspective and understanding the loosening credit crisis. And we go back to look at 2008, where you had a lot of the documented loans, or the no doc statement loans, where you just state your income. They weren't verifying anything. Anybody could get a house. Everyone had adjustable rate mortgage. And so when you start seeing the loosening credit standards while extending the terms at the same time, I think it's a recipe for disaster, because there's going to be some people on the back end that are going to get, I won't say predatory, but you could call it predatory, because you're getting into a product and you're getting into a loan that isn't set up for success. We already know, even with the 30-year mortgage, that the front end on the interest payment is crazy. And when you look at the details of the 50-year, that it's even worse when you start looking at how much interest is front loaded on the loan and how the amortization works. And so the thing is, when you're looking on the investor side, it's like, okay, what is the credit risk? With if I'm investing in maybe a private equity fund that is lending money out at 95%. If I'm buying mortgage-backed securities, MBS, what is that going to have to the credit risk? Guess what? That's going to push interest rates up. And with people building equity slower, you can't foreclose. You get an asset that's not worth the loan value because it may have only went down, or they lived in it for 7, 8 years, and now it needs renovating 30, 40,000, and there's no equity. And so now, from a banking institution, you're upside down in the loan. And so the thing is that you have to look at, is this really a good loan product for you, or should you wait until you can afford to have a 30-year mortgage at the end of the day? And so we're really looking at kind of the analysis and putting a case study together. I looked at a home price that was 500,000 with a down payment of only 5%. So the loan amount was 475,000, and I did a rate at 6.25%. And so a credit score, we'll take it. Credit score 600. You don't have to meet the 620 minimum anymore. So we're going to say a credit score is 600. So for a 50-year loan, that mortgage payment would be $2,770. For a 30-year loan, the mortgage payment would be $2,925. So only about $155 difference. So he's like, okay, $155 difference, but you're adding on 20 years to the loan. And so this is kind of when the devil's in the details. So we're looking at that 7-year mark. So how much principal would be paid down in 7 years? On the 50-year mortgage, guess what? You're going to be paying off only $13,700. Now you're going to be paying $2,770 for 12 months, every month for 7 years. And guess what? You're only going to have $13,700 paid down on your principal of your loan. For a 30-year mortgage, guess what? You're going to, at that point in 7 years, you're going to pay down $45,100 paid off. And so basically the 30-year loan builds equity 3 times as fast as the 50-year loan. And your interest payments. So on the 50-year loan, during that 7-year period, you made $133,000 in interest payments, and you only built up 13%. You only built up 13,000. So 90% of your payments went to interest, and only 10% went towards your principal in those 7 years. And then 30-year mortgage, 116,000 went towards paying interest. So there's a difference about 17,500. But the thing is, the payment difference is small, but the long-term impact is astronomical. The 50-year borrower, you're going to stay in debt longer, you're going to build equity slower, and it's a greater risk that the home price is going to drop, or if they go up and down during that time, you're going to be left holding the bag. And you definitely can't sell anytime soon without taking a loss. And I think this matters for both families and investors at the long term when you start looking at the risk. And really, when you see the systemic risk that it was all there before, when you look at the financial crisis with everything that happened in '08. And the thing is, we want to kind of get out of that cycle and really understand what we're doing and being an informed buyer before we're making emotional decisions on getting our forever home to sell to save $155 and end up putting ourselves in a very bad financial position long term. And so affordability versus sustainability. Yep, the 50-year mortgage, you make payments easier by $150. You can stop buying coffee or whatever. They say don't buy Starbucks or whatever to save money, but figure out something. You can change your habits to find $150 in your budget if you want to. And that's a decision that you have to make, because you're going to be screwing yourself over long term when you start looking at all the interest that you're paying and the lack of equity buildup over time. But the thing is, you're stretching out that debt over essentially over half a lifetime, 50 years, more than half a lifetime. And so that's the thing that you have to look at. The average male lives to 75, and you're doing a 50-year mortgage. So the majority of your life, you're going to be having that mortgage. And the thing is, you're never going to build up real equity. This is setting you up for fail. So please, I would say it's got to be a really crazy situation that I would recommend someone look at a 50-year mortgage. But hey, you have to be informed and make sure that you understand the challenges. You're going to have decades of debt, and I think you really will create more problems by trying to unfreeze the market with higher interest rates and inflation. Because at the end of the day, prices are just going to have to drop. And I'm a real estate investor, and the thing is, if we want affordability to happen, either increase wages, which we don't see a lot of that happening. Heck, they're laying off a lot of people with AI, and that's going the opposite direction right now. So the thing is that you're going to have to look at, we're going to have to see how prices drop, or we're going to have to bring in multi-generational homes where you're going to have multiple people living in homes where now it's affordable because you have more individuals contributing to the bills and to the mortgage payments in order to make it happen. And we see that in a lot of other countries already. I think that another within the United States, the big one is Canada, where we see that already with higher interest rates, where like the average home price is a little bit over $1 million in the major metro areas. And we see this as well in Hawaii, where historically Hawaii has always had higher than average home prices. And you see a lot of multi generations that all live under one roof just because of the affordability issues that we see here with where we are right now in regards to our household income. But I think at the end of the day, it's definitely a slippery slope when you look at how we're changing all the rules right now. And it's important that you than ever that you be informed. And you see all these things, they're being coupled together where you're removing the 620 floor remove from like the credit worthiness. It's like if I'm a bank and I'm putting my money in the bank, why would I want the bank to lend money to someone that hasn't paid the bills or doesn't pay the bills, or maybe have a foreclosure? It's like you have to have scrutiny in there, or you're gonna realize a lot of risk. And the thing is, if you don't know what you're signing up for, you could be left holding the bag and setting yourself up for a lot of pain further down the road. So the 620 rule with that floor being removed, 50-year term, pushing that out, extremely long mortgages. And then now, maybe they're going to be talking about next year, hey, they're going to come back with a 60-year loan and for loans with people with no credit score at all. But the thing is, like, the system continues to try to perpetuate this and find a way to make a product to be able to create profit near term in order to appease the shareholders. But at the end of end of the day, we got to fix the fundamentals, because I think this is just putting a band-aid on the affordability problem that we have across the United States. So I think for investors, I would love to hear what you guys are looking at. Like, for what are you planning? Are you planning? Are you even considering a 50-year mortgage? When I saw it, I was like, yeah, that's a scam all day when I initially saw it. But the thing is, you have to look and understand to make sure that you're assessing the risk, you're making informed decision, understand how the lower credit borrowers are more likely to default. You got to take that into your calculus. You got to understand, how do you protect yourself in case the market shifts quickly. If there's an oversupply market, or you're right beside Apple, and Apple and Tesla all leave your market, say we're going to build our headquarters elsewhere, and a lot of jobs leave, or a base shuts down, and this the largest provider in the area. What does that mean for you? What are the risks that you're carrying with your portfolio that you definitely want to keep that top of mind? And then how do you protect yourself? How do you hedge yourself against the risk? Do you diversify asset classes? Maybe you don't go all in on residential real estate. Maybe you look at multifamily real estate. Maybe you look at self storage. Maybe you look at some private credit that is not tied to real estate with all your assets, where maybe you make some portfolio decisions where you're not putting all your eggs in that basket. But at the end of the day, you want to definitely stay updated on the lending changes, because things can move fast. And I think the big thing at the end of the day that we got to ask ourselves, and it's, are we walking into a decade of new opportunity with all these changes, with AI, with robotics, 50-year mortgages, no credit scores to get a house? Or are we entering a new decade of risk? And I think the thing is, you have to look at it with lower credit standards, longer debt, slower equity buildup, that I think we're going the wrong direction. But you guys have to decide what works best for you, and understand, be informed investor at the end of the day, and don't let anyone dictate how you're setting up your portfolio and the things that you care about long term. And so that's what we're moving towards. But I love to hear you guys' take on everything that goes. I say, does it apply to refinancing too? I'm not sure. That's a great question from investor success mindset. I'm not sure if this applies to refinancing and being able to do that. But that's a great idea. Maybe you have a property that's, right now you don't have a lot of leverage, that you're at 50% loan to value, or maybe you don't have a mortgage on it at all. Maybe you get a 50-year mortgage and the cash flow comes in, and you're looking at an opportunity to refinance and pull some money out, but a longer repayment term. And the thing is, maybe that 155, I think the big thing that you really look at is like $155 on a $500,000 home. That's not a big difference. It's like you can make that up somewhere, or maybe you need to restructure some things, because if you can pay down early, then why even go to 50-year mark? Because it really doesn't buy you anything. You're just throwing a lot of money into interest that isn't really necessary. So it's something that you really have to consider. But yeah, refinancing may be an option as well too. Let's see what Michael said here. He said, I try and tell people to house hack a family and then move. Also, is the 50-year mortgage already in Europe? I'm not sure if in Europe. I'm not sure if it's in Europe already. The For whatever, a lot of times that you see why a lot of foreign investors love the United States is because we're only place in town that you can get a 30-year mortgage. Most countries, their mortgages are reset at their adjustable rates at 5, 7 years when you look at different countries. And so that's one of the unique things with the United States and why a lot of foreign investors really love America, because you can get 30-year debt, which is atypical. So most likely, I don't think there's a 50-year product in a lot of other countries, but that may be something to really look into long term. Um, on the other front, with Michael, he said here that the house hack, 100% house hacking. When we talk about multi generations under one roof, that we're gonna have to change. The economy is changing across the board, and so that's one of the things that we're gonna have to look at what we're doing. We're gonna have to make some strategic changes on how we're building wealth, how we're investing in different asset classes, how we view home ownership. One of the things with a friend of mine, Bill Huff, was always he talks about really big about duplexes, and he's in the San Antonio market and a lot of new construction duplexes that a lot of people hesitate with moving into a duplex because their emotional mindset is really focused on the single family home and the American dream, and they can't really wrap their mind around the benefit of owning a duplex, living in one side, renting the other side, and having that rent cover the majority, if not all, of your mortgage payment. But a lot of people, they see the home, even though they're going to be in it for 3 or 4 years, because San Antonio is a huge military town, that they can't really see. Hey, sacrifice 3 or 4 years, live in the duplex, rent out the other side, and set yourself up when you're gone 3 or 4 years. Now you have two rental properties, you have cash flow coming in, and now you're setting yourself up for building long term wealth. And one of my clients, shout out to Darrell, just bought a 4 unit in Jacksonville with his using his VA loan, no money out of pocket, had 3 units already set up as short term rentals, and he's living in 1 unit. And talk about already winning, but you have to change your mindset on how to position yourself to build wealth, because the old days of just buying a single family home, be moving in 3 or 4 years, renting it out, and it's still cash flow. That where interest rates are right now and where rents are, that is not keeping up, especially if you're in a high price market like Washington, D.C., or, looking at the Austin, Texas, Los Angeles, and as you get out west. And that's one of the things that really pushed me to Alabama, and what I really love about the affordability and to be able to cash flow. And so that's always been critical and top of mind, where I never really bought for long term appreciation. It has always been really focused on cash flow from day one, and it really sets you up long term. Uh, so I think those are great comments. Thank you guys for adding in that information and really commenting. Because at the end of the day, you have to do what's best for you and really make those decisions on how you can strategically set up your real estate portfolio, but then also diversify into other asset classes and looking at finding those competitive advantages with everything that's continuing to be dynamic and changing in the economy. We have to look at see how we can set ourselves up for long-term success. Um, but that's with that. Any questions? Any additional questions? I think there was great conversation. I know we have a couple of people in in the studio that we're going to do some networking here, and definitely let's drop the link in the chat for those that want to join. I'll add that in the chat where you can come in and join here as we do a little bit of networking offline and join the conversation. As always, love to get feedback from you guys on the topics you want to cover. I know some of the things we have coming up. We're gonna have G2 accounting firm based out of North Carolina. They're gonna come share next month. And I think as well, I think we have another bookkeeping session for real estate investors that's going to be coming online as well. And so a lot of things that's happening with REI Genius. One of the things that we're looking at, we're setting up our multifamily accelerator as we're going into next year. I just signed an agreement with CoStar this morning with accessing the CoStar data, and we're about to get after it with some great things on the multifamily side. This silver tsunami with a lot of older landlords looking to retire and not necessarily liquidate, because a lot of them we work with that they like to do seller financing, but a lot of things happening. There's going to be a lot of assets and wealth changing hands long term over the next decade. And so the thing is, make sure you're having those conversations and you're part of the conversation as we're looking to buy more 40 unit and below apartment complexes And even with potentially with us launching our investment club, that I think we're going to be looking at even some bigger multifamily assets that we can take advantage of the opportunities and continue to build wealth together. So, with that, we'll see you guys next week. For those in the studio, let's hang out and talk a little bit, network. And I will see you all next week on another edition of $1 Million Coffee Hour. Make sure for those on YouTube, LinkedIn, subscribe to the channel, give a thumbs up, and would love to hear more feedback from you guys on what you want to see in the future.